What's going on, everyone? I hope you're all enjoying your long weekend. I've been working on some stuff as usual, and this is pretty exciting. I feel like this is going to be just as good, if maybe not even better, than the bullseye alerts that we already have. This is sudden surges. I'm sure you saw it show up in the Discord last Friday. And what we can do with this is basically gauge sentiment from the options market makers and or large players, and basically take their sudden surges of volume that come in and play off of that. Now, what this is a basically a conditional scanner using nanosecond granularity real-time options WebSocket that posts the data as it comes in real time to the Discord that we can then use to interpret, break down, and hopefully profit from. Let's go ahead and take a look at this. This is going to be real brief. I will explain this in further detail before the weekend's over. I just wanted to get you aware that this is going to be a new thing starting next week. So first thing, what are they? Well, sudden surges are live trades that contain volume of over 5,000 contracts or more in a single trade. Now with this, you're also going to get two very important data metrics that you're going to want to look at. But first, where to find these? At the very top of the server, you will see them under the announcements channel. I will leave them there for now until everyone gets used to where they are. And then I will move it slightly down to where all of the other main play opportunity channels are, like the bullseye and the quant feeds. But basically, this is what they look like. And I will be working on improving the output to make it more visually appealing. So bear with me on that. You're going to get the symbol name. Now, when it comes to option symbols, they operate a little bit differently than your traditional ticker symbols. So looking at this at first glance, if you're not used to reading option symbols, it looks like just a bunch of nonsense, but it actually does have all the information you need within it. And I will be working on optimizing this output as well to provide a more easy to read output for you to be able to tell the symbol faster. But basically, the way that you read this, and whenever you read the symbols, you have your symbol is always going to be the first 3, 4, or 5 alphabetical characters. So CVS, we can clearly see, is right here. Following the symbol's name or the ticker's name, you're going to get the expiration date. And it's in the format of year, year, month, month, day, day. This will be the same across all option symbols. Then following that, it's going to be whether or not it's a call or a put. So you should see a C or a P. And then you will always have 3 zeros after that. So just ignore the 3 zeros, at which point you will be at your strike price. And as we can see here, this is going to be for the 87.5 strike. And I know there's not a decimal point there, but the way you would know that is whenever you type in Citigroup in your brokerage app to visualize it and see what's going on, you'll notice that CVS is trading nowhere near $875. So the only strike this could be is 87.5, and it also will match the volume to a T. So this is a call example. We have CVS 2023 February 17th call at the 87.5 strike that showed up on the surge alert on Friday. Down here at the put side, we had a Citigroup put that came through, and this one had a surge volume of 5,325, and you read it the same way. C 230120 put $65 strike. Now, whenever else you are looking at these, this is what you're going to want to look for specifically. You're going to want to look at the price, which is the price paid by the trader who made this trade. And you're going to look at the opening price of the contract, which this is the opening price on the day. So this contract for CVS opened today at 2.98, and then it was purchased at 4.2 at the very tail end of the day. I'm going to add timestamps to these as well because those will be important also. But basically, now is the time where you can start thinking about, okay, what's going on here? If you paid 4.2 and the stock opened at 2.98 and you bought 15,000 contracts, there's literally zero chance that this is an opening position, and it's likely contracts being sold for premium. That is the beauty of this feed. Now, if you look here, if the price is greater than the opening price, it's likely going to be premium position. If the price is less than the opening price, it's likely going to be an opening position. Now, what you'll also notice here is that the calls likely are going to be premium and the puts are likely going to be an opening position. Now, take a look at the state of the markets right now. Everything's basically overbought, and then you can kind of connect 2 and 2 together. So once you've got that, then you can go look at the options chain to verify that the volume coming in is accurate, and it should always be accurate, but it's always good to check just in case. And what do you see? Well, right here for CVS, 87.5 strike, 15,089 volume, 15,080. So this one actually has 15,080. So 9 more volume came in on the day after this feed hit. So this trade here of 15,000 took up the majority of this entire chain here for the 87.5 strike for February 17th, 2023. Now, think about this. With CVS, the contract opened at 298 on the day, and a volume surge came in at a price of 4.2. This means since the contract closed on Friday at $3.80, whoever sold these contracts raked in $40 per contract times 15,000, which is $600,000 in premium that was made on this position, and they got that money up front for selling those calls. Pretty crazy. Now with Citigroup, on the other hand, I want you to take notice of the price and how it's similar to the opening price. They got it at a very, very, very shallow discount. But what's important to note here is the delta. Because if you would expect markets to be trending downwards soon, and Citigroup is a pretty popular bank stock, well, I believe you can easily consider that they just delta hedged, considering the very first strike that hits that -1 delta is the 65, which is where the volume came in. This one had a surge volume of 5,325 at a price of 15, which is exactly where this ticker closed, and it's the only one with 100% delta at this moment in time. So that's basically it in a nutshell. These should provide play opportunities as they come in, and the way to determine what the play is to look at the contract. The contract coming in will be the play, but it's either going to be a premium play or a long play. So if it's something like CVS, it would be a premium play. If it's something like C, it would be a long play. Now, considering the cost of these are $1,500, you don't have to play the strike that comes in. You can use your better judgment and maybe pick up one of the closer ones in the money, or maybe slightly out of the money. That's when it's up to you to determine the best way to tackle it. But the play opportunities in and of themselves are going to be found in this channel, and they're going to be, after you do some very, very light interpreting, you should be able to figure out a clear path to profit for these particular plays. So again, just to reiterate, sudden surges are going to be volume spikes, market-wide detectable. As soon as it happens, it's going to post to Discord within a nanosecond of the trade occurring, at which point you can go and look at the chain to see what's going on. Maybe look at the state of the RSI. Is it overbought? Is it oversold? And then you can pair that logic with the logic of, okay, is the price greater than the opening price of which they bought it at, or is it less? If the price is greater than where it opened at, likely they're selling you premium. If the price is lower than where it opened at, likely they're buying the dip. That's basically it in a nutshell. But yeah, look at that delta, man. I would definitely also go look through these to see the landscape of what the options chains look like on all of these. You'll be quite surprised. This is just a couple examples, but if you take a little bit of time and go look at all of them, it's clear as day what the sentiment is. And that's the goal of these feeds, is to provide not only a play opportunity, but which direction it's likely to go, not based on any AI confidence or anything like that, but just based on fundamental options characteristics, how they work, and using our better judgment to make that call. But yeah, this should be very good. I did personally jump in on the Ford surge volume play that posted on Friday as a test. So we'll see how that pans out next week. But yeah, this should be very exciting moving forward and should provide for some lucrative opportunities. So I hope you all have a good rest of your weekend. And yeah, I will be working on cleaning up the feeds to provide an easier output to read the symbols, and we'll provide greens for calls, reds for puts, all that good stuff. I just wanted to get this out so that everyone had a chance to look at it over the weekend. So I didn't hit you with something new, on Monday night. Now everyone's got a day to at least know the gist of what's going on. And from here, I'll only be optimizing the output to make the opportunities more lucrative and easier to read. So anyways, y'all have a good rest of your weekend, and let's go Jasmine.